Today on InvestTalk, we talked about Volkswagen and what it really means for the German economy. Answered questions on Zim integrated shipping, Dollar General and Roth conversions, and finished off the day doing an analysis about the potential impacts of Trump's economic policies next year.
This is InvestTalk, independent thinking, shared success.
Now, my main focus point concerns this question. Volkswagen in crisis. Can Germany's auto giant survive the shift? And to put this in context, Germany narrowly avoided a recession this past quarter, with its economy seeing just a little bit of growth, about 20 basis points, thanks to a boost in government and household spending. However, this minor uptick doesn't erase larger concerns about Europe's largest economy. The IMF, International Monetary Fund, expects zero economic growth, zero for Germany this year. And one of its leading companies, Volkswagen, exemplifies the challenges facing the country as a whole. Volkswagen announced a sharp 21% drop in profits over the first 9 months of this year, citing poor performance in China, but also restructuring costs that are maybe idiosyncratic, business specific. Demand for its vehicles slipped, not just in Europe, but in China as well, where local electric vehicle brands really have a dominant market share. And so this crisis has led the company to consider some pretty painful measures, including factory closing, significant job cuts, and what could be its first really major shakeup in 87 years. The challenges are not just exhibited in Volkswagen. It extends across the German economy, particularly in manufacturing. A recent survey showed a drop in employment for manufacturing and services, signaling pessimism in business for businesses and consumers alike. For Germany, a lot of that is because of high labor costs, weak productivity, and fierce competition from China, which really compound its economic problems. And so as China increasingly produces locally what it used to import, German exports are struggling to find markets. And this is really indicative of a lot of economies across Europe. A recent report by the Federation of German Industries warns that Germany could lose about a fifth of its industrial output by 2030. That same study also notes that Germany's traditional advantages, such as skilled labor and manufacturing expertise, are now under threat. And that's because high costs, taxes, but really most importantly, an aging workforce is adding to these pressures. And so to tackle these issues, there's certainly some things that Germany could do, but a lot of that would require an economic transformation at a scale not really seen since post-war reconstruction. The estimates from analysts, about 1.4 trillion by decade's end. But that's really not, for lack of a better way of saying it, the German way, right? The German government is practicing austerity. They were the leaders of suggesting austerity for the European Union in the wake of the stimulus coming out of the great financial crisis. And so the tight government borrowing restrictions and disagreements really make having transformative changes a problem. So for now, I think it's likely that the German economy and the brighter days of the German economy are probably on hold a little bit, at least until 2026. It does not seem that there is likely to be the ability to have transformative change, especially ahead of Germany's upcoming elections. And so both businesses and policymakers over this time will certainly be weighing what possibilities there are, and ultimately, the German people will decide. To dive deeper into financial education, head over to investtalk.com. U.S. stocks were sharply higher today, ending near best levels as the Dow, S&P 500, and NASDAQ all set fresh record highs. The Dow up 357 basis points, 3.57%. S&P 500 up 2.53%. The NASDAQ up nearly 3% at 2.95%. Russell 2000 small caps up 5.84%. The rally largely extended gains that saw all of the major indices up over 1% on Tuesday. Outperformers included small caps, banks, construction materials, media, credit cards, energy doing well. Underperformers, relative underperformers that is, included solar, copper, which was down on the day, China tech, hospitals, home builders, exchanges, and precious metal miners. Treasuries saw some meaningful pressure. The curve steepened a little bit on the longer end. Yield on the 10-year note now up 80 basis points since mid-September. Dollar index up 1.6%, its best session since September of 2022. Gold finished down 2.7% as bonds fell. Copper settling down 4.9% today. Overall, a sizable rally sparked by the Trump election victory and, as I mentioned, that potential red sweep or whatever you want to call it. House, though, still not decided. There are definitely some paths that lead to uncertainty there, but the Senate and the presidency have been decided. And overall removal of election overhang uncertainty, really another widely discussed positive for the market, particularly with the pickup in defensive positioning over recent weeks. Other pieces of bullish news, favorable seasonality, of course, with a lot of earnings being in. There's going to be the end of the buyback window. And that last week, the end of October, because that's the fiscal year for most, or for not for most, but for a lot of mutual funds, that being over means that, well, there could be peak end of year selling for mutual funds, which could artificially keep prices a little bit higher. From an economic perspective, really nothing on the calendar today. Thursday brings Q3 non-farm productivity and labor costs, as well as initial claims. And an FOMC announcement and Powell press conference is also set for Thursday afternoon. The Fed widely expected to deliver a 25 basis point rate cut, while Powell likely to stress data dependency when it comes to policy decisions going forward.
Hi, I've got a question. I was curious about security symbols Z as in zebra, I India, and Emera. Just like to know what your thoughts are. I was hoping to buy some. Thank you.
So the ticker is ZIM, Zim Integrated Shipping Services. It is a global shipping company. It offers a variety of services, including container shipping, dry cargo shipping, inland transport, digital services, scheduled services, all sorts of services. It operates in all the major oceans, right? 14% of its revenue comes from the Atlantic. 39% of its revenue comes from the Pacific. And in the past year, well, it's done pretty well. It's up 210% in the past 52 weeks. And the reason why is, well, they had a little dip in revenue coming out of the pandemic. Certainly things were not moving globally as they normally would have, right? 2021 saw $10 billion in revenue, then $12 billion the next year. It'll dip down to $5 billion. Certainly there's been a lot of tensions, but revenue is back up to $7.629 billion. Their margins, although they lost money last year, they're projected to make money again. 17.9% net margin, though down from their peak of about 43.3% coming out of the pandemic. And so this company, which is an Israeli-based shipping company, saw, like I said, a good recovery coming out of the pandemic. They pay a pretty solid dividend. Right now it's at 4.68%. You look at a dividend yield on my screen, it's pretty gnarly in 2023 and 2022. And their dividends kind of all over the place. It's about $2.50 in 2021, $27.55. 2022, projected to be about $3.88 this year. In terms of relative valuation, well, it's trading at a forward-looking price earnings of 12, which doesn't sound that high, but the 5-year average is 5.2. Its price to book is about 1, which looks a little bit low to me. But overall, I think the run-up has kind of just run out of some steam. It's down 3% today. I think there's still a lot of tensions in that particular part of the world that could hurt shipping. There are threats of more strikes at ports that could hurt the importation of goods, right? There was after the last strike at the ports in the Gulf and in the Atlantic, it took a while to get the amount of ships that were sitting outside of Los Angeles. I still don't even know if they've gotten through the backlog. And so that affects the bottom line when things get delayed. You can't get your ships going. I think there's a lot of uncertainty there. I think it's had an incredible run up, certainly, over the past year. But you know what? It's important to note here that cash flow's fallen a lot from 2022. We know profitability has fallen. They got about $5.5 billion in debt on a $2.986 billion market cap company. And what's the market telling you? Sometimes you have to listen to the market. And when the market has 17.81% short interest out there, the tail risk of being long this name, right? It can be pretty gnarly. So overall, everything that I'm seeing, kind of some of the prevailing macro factors that are out there, I think for now, we're going to have to pass on ZIM, that is Zim Integrated Shipping Services. Let's dive right back into the InvestTalk question bank. This one coming over from our YouTube channel, that is InvestTalk with 2 T's. And if you're watching the video and you go, you know what, I have a question on my mind, you don't have to pick up the phone. Unless you're watching it on the phone, then I guess you already have the phone in your hands. But you can go over to the comment section and leave us a question. This one coming in from Blackberry7. It's about EMA. It says, if I am not mistaken, you said in past podcasts that renewable energy companies are gaining traction in the energy sector, especially electricity. Do you believe that EMA is the ticker, would be a good company to invest in, get more exposure to renewables at what entry point? So Emera is a renewable energy company. It operates through its Florida electric utility, gas utility and infrastructure, and Canadian electric utility company. And so it essentially works to give or work within the space of Canada, the United States, and the Caribbean in delivering electricity and natural gas. It's down 1.76% today, and revenue's kind of been stable over the past 5 years. Annualized growth rate about 0.6%, though better over the past year, going from 6.5 billion projected to be 7.7 billion this year. Debt levels very low, about $20 million on a 14 billion. It's probably Canadian dollar market cap right there. I'm sorry. That is the wrong ticker that came up on my other screen. But this one, if you're watching at home, is completely fine. Debt levels, not too crazy, about 62% of its total market cap. Cash growing over the past 2 years from 332 million to 558, certainly on the right direction, though free cash flow is still negative for this company. Looking at their forward-looking price to earnings, it's a little bit lower than their 5-year average. Price to book, about 1.3. That's fine. Price to sales about 2.1. Again, for a utility, you don't want to see too high of margins there. I think this is, for me, you have a situation here where the incoming administration is likely to want to invest in domestic oil, natural gas, pump as much as they can, drill as much as they can, export as much as they can, in a way that, again, right, looking back towards 2018 is actually the year the United States became the number one exporter of oil. That has grown every year since through the Biden administration. That trend will certainly continue going forward. And so if I had to make a bet on a utility company that provides natural gas and electricity and energy management services, I would probably buy one whose supply chain runs more through the United States than the supply chain of this company does. Certainly a Canadian company, though most of its exploration actually comes from outside of the United States. So again, I think that Canada's number one export, I believe, is actually still energy-related products. But regardless, I think that keeping in mind where the next administration is likely to go, I would probably favor investing, again, in a company that is more exposed to U.S. products than Canadian products. Though it is important to note that geographically, based on their revenue here, it looks like the United States still does make up 70% of the revenue. But overall, this company's been pretty flat, while most utilities have done particularly well this year. So on ticker EMA, that is Emera Incorporated, I will have to pass. Thanks for watching. Looks like we got a live call. Sid, thank you for being patient. How are things in North Carolina?
Oh, thanks. Things are great post last night event. So we are now back to normal life. Thank you for asking, and thanks for taking my call.
Well, glad to hear it, and I'm glad all the advertising is over for you now. It looks like you have a question on DG. Do you own it, or are you looking to buy it?
I own it. I had picked up a small quantity when it went down to all the way 85, and I thought probably that's the right price. And I do have a few friends working in the company, so I have some idea. They do have 20,000 plus stores and a lot of other things, but I thought maybe the price may go down, and that's the case right now. 70 today, all the retailers are down, so it's a different story. But do you think I should be looking at adding more at this price, or should I be more patient and it may go further down? I would like to hear your inputs, and thank you.
Well, of course. Well, thank you for desiring my input. I will certainly give it to you. And so DG is Dollar General. For those of you who do not know, it's a merchandising store that sells products that tend to be discounted products to lower income end consumers generally. Now, they haven't been doing too well in the recent past, and the reason why is, well, the lower end of the bracket of income brackets are not doing well, and that's their customer base. And the upper end of their customer base has really been soaked up by companies like Walmart and primarily through Walmart's e-commerce. And so taking a look at this company, it has, again, not been doing well. It's down 43% year to date, down 30% in the last 3 months alone. And it has, well, still positive looking cash flow. They've been buying back shares. They're only about $18 billion in debt, but guess what? They're only an $18 billion market cap company. But even with that in mind, their interest coverage ratio is about 8 times, meaning that the leverage isn't really weighing on the financial health of their business, and the cash flow is still positive. So the question is, why is it down 5% today? Well, it's plain and simple, right? Part of Donald Trump's platform when he was running was tariffs. And how does Dollar General keep prices low? They import a lot of goods. And so if tariffs are put in place, they're either going to be forced to buy American, or they're going to be forced to pay the tax on the imported good. And then that tax will get passed along to a consumer that is already stretched. And so it kind of hits it from both ends, because this is the retail business, right? Margins are not that great in the retail business. About 3% net margin is what it's projected to be this year. They're very tight. And so when you have a consumer base that is already kind of pushed a little bit, and you're faced with the prospect of either raising prices, really either way raising prices because your input costs are going to be higher if tariffs are put in place, well, then it's not necessarily good for the stock. And that's why when the rest of the market is up a lot today, this is down about 5%. So I would wait and see, right? Like, we don't know, and this isn't just about, Donald Trump particularly. People make campaign promises, then people put in policy. We're going to learn a lot more in the coming weeks, the coming months, about the people that'll serve in his cabinet, what the economic policy is going to look like, what the full makeup of government is going to be. And that should give us some signal as to what the economic policy is likely to be going forward and how close it will mimic what he campaigned on. And that's when we'll get we'll be able to glean some things on some companies like this that would certainly be hurt in an environment that had tariffs on imported goods. Does that all make sense?
Yes.
Awesome. Well, thank you for the call. Looks like we have another live call. James from San Francisco has a question about Applied Materials. Do you own it, or are you looking to buy it?
Oh, yeah. This is a company I had. I've been watching. And I actually, I called in, I think it might have been a month and a half or a couple of months ago. And I asked about Applied Materials because it's a company I've been watching for a while. It's been on my watch list for about a year now, but I just hadn't really been, I want to make a long-term investment. And I'm glad I waited, because it did pull back with the rest of the tech, the rest of the tech stocks. Considerably. It pulled back, but it hasn't quite pulled all the way back to the 160, 170 range. But it really is a good company, and I'm interested in a long-term investment. So I was just curious what your thoughts were on that one.
Yeah, of course. Well, thanks for calling back. We always like hearing back from our callers, especially on similar questions. And Applied Materials, that's ticker AMAT, is a key player in the semiconductor space. Because of that, it's kind of benefited from the long-term secular growth theme, which is artificial intelligence. So that's a little primer on what this company does. When we come back from the break, we'll dive more into its balance sheet, its fundamentals, what its growth has looked like, and maybe what the macro environment tells us more broadly about if now's a good time to buy. Now, before the break, we were talking to James from San Francisco, and he had a question about Applied Materials, ticker AMAT, and he was correct in that this is a very solid semi company, and it's been an integral part of the secular growth theme that is driven by generative artificial intelligence. Now, it is a $153 billion market cap company. It's got very little debt, only about $6 billion. Pays a pretty solid dividend, which a lot of semi companies do not. Its dividend per share has grown from $3.23 several years ago in 2018, projected to be $8.53 this year. And yes, shares have been bought back, but only to the tune of about, I don't know, just under 100 million. So that's really just the benefit of, well, their increase in cash flow over the past 5 years. They're improving margins over the past 5 years from 19.2% net margin, projected to be almost 30% this year. That's 26.2%. But the question is it a good buying opportunity? And it's still trading ahead of its 5-year average of price to earnings. It's still trading above its, or really at its 5-year average on price to book. It's still trading above on price to cash flow. And one thing that is well noticeable is the market is up a lot. It's only up 56 basis points today. And so one thing that gives me pause here is, again, related to having to process what changes might be on the horizon from a really stark shift in economic policy, and one that may be more aggressive in tariffs and other means of trade retaliation towards China, right? The people that I've seen who are likely to be in the Trump administration related to trade, very hawkish on China. He was very hawkish on China the first time around. And so there's an opportunity here, or a potential likelihood here, that the 27% revenue stream that comes from China could be at a little bit of a threat, because if you enact tariffs, there may be some retaliatory tariffs as well. So I think that might be one of the reasons why it didn't climb as much as the rest of the market did today. It's still about, it's like 8.8% underperforming the industry in spite of it being up about 15% over the past a year, which is underperforming the market. So I think for now, I would still hold on. Again, there's a lot of uncertainty about potential trade policy that could certainly affect a name, particularly in the semi space that is really exposed to China and Taiwan, 21% exposure to Taiwan as well. Thanks for the call. We asked for live calls, and boy, did you respond. Jerry from Palo Alto asking about ticker S and listening on AM 1220. Do you own it, or are you looking to buy it?
I have it. I'm looking at it. I've done really well. And I'm looking at a great profit, but then it says I'm just doing real research, a net loss narrowed to $69.2 million. So this thing's going really well, yet it's got a net loss, and I might have old figures there. But is that normal for a stock to go up that well, yet with those kind of losses?
Well, SentinelOne is a endpoint security software company. I think for those who don't know what that means, its top competitor is CrowdStrike. And yes, it has net operating losses. It lost money in 2023, it lost money in 2022. It's projected to make money for the first time this year, though it doesn't mean that their net operating losses and carryovers are going to be entirely positive. So the core of your question is, how can a stock outperform when it's not making any money? Well, plenty of stocks do it, because at its core, the price of a company should be theoretically some present value of future cash flows of the company. There are plenty of stocks that didn't make any money for decades. Amazon, right? Uber. Not decades for Uber, but years for Uber. And so there can be cash coming in. There can be capitalized expenses. There can be a lot of expenses that are oversetting that cash. People take on debt. They issue equity. So it's perfectly plausible, and this seems to be the case, that a stock is up 76% this year, still hasn't made any money. It looks like it's finally turning the corner and going to make money this year. One thing I don't like about it is they do issue a lot of shares. And so when you see a company that doesn't make money, typically they're going to have to finance through, well, debt or equity. They choose to finance through equity. And so there's a lot of short interest out there, about 5%, not a crazy amount of short interest out there. And if you're up a bunch, I say it all the time, no one went broke taking any profit. No one ever went to broke taking profit, excuse me. So I would always recommend, if you're up that much, maybe you bought it a year ago, take some profits, enjoy it. Thanks for the call. Let's keep it moving and fit in another InvestTalk listener question.
Hey, Justin or Luke. How you doing? This is Jason from Atlanta. Calling you about Crocs this time. I've been watching it for a little while. I like everything that was going on, but that dip after earnings about Hey Dude was crazy. I bought it, and it just kept dipping. I just want to know what you guys think about the stock, and if there's going to be a turnaround, how soon do you think that's going to happen? All right, I appreciate it. I'll listen to it on the show. Thanks.
So taking a look at Crocs, I'll load it over here. Crocs is it's a shoe brand, right? If you've ever seen them, they're kind of like the sandally looking shoes that kind of got a little loop that goes over your foot. They got some holes in them, and they got some very fun various Crocs. I have a friend who has many pairs of Crocs, but they're really all the rage. There's been a lot of revenue growth, right? You see that right here. It's grown 30% over the past 5 years on an annualized basis, though that has flatlined a little bit coming into this year from about 3.9 billion to about 4 billion in revenue. But cash flow, man, just exploding, absolutely exploding. Look at free cash flow here. From about 53 million back in 2019, projected to be almost $1 billion this year, 812 million. And profitability is great, 19% net margin this year. In terms of debt, well, they got 1.7 billion, but they're $6 billion market cap company. And again, cash flow is great, profitability is solid. They have a lot of room here, about 10 times interest coverage ratio. And all this time they've been buying back shares. And so what has happened recently is Hey Dude struggles really have impacted kind of the results for the Crocs brand. Their latest earnings, still though, they had a surprise. It's supposed to make 3.1 on bottom line EPS, hit 3.6. Sales supposed to be 1.05 billion, hit 1.062. Forward-looking guidance was fine, but the question is this a solid buying opportunity on a company that's down 2.3% today when, again, the rest of the market is doing pretty well? Well, honestly, it looks cheap to me. Price to earnings, about 8 times. Price to book value, about 3.6 times. I mean, look at that relative to its 5-year averages. And so, honestly, it seems like a pretty good deal right now. I don't say that very often, but I think you have some unique circumstances that are indicative of this company, which is strong buyback support, right? Which is going to help keep prices higher, elevate prices, and you have strong cash flow. So overall, I honestly like Crocs. I think it's trading at a pretty solid value right now. Thanks for the call. Let's make it 2 in a row and play another caller question.
My name is John. I have a 457 through my employer. They don't match it or anything. I've just been invested into it myself. I have almost $400,000 in there, and it's been in a very safe haven. I've only been collecting about 2% interest on it for a number of years. I'm 70 years old. I'm retired from the NYPD. I have a pension. I just signed up for my Social Security at 70. I was wondering if it'd be worth it for me to roll this 457 over into a Roth IRA. You can answer a question. I'd really appreciate it. And thank you again. Bye-bye.
I was actually talking to a client today about a Roth conversion, and the reasons why it was beneficial to them is one of the reasons why it can be beneficial to you as well, right? For those who don't know, 457, it's a retirement account for government employees. It's a government-sponsored retirement account. It's just like your 401ks or 403bs. And it has tax-deferred growth. And so the difference here is, unlike most retirement plans, there's no early withdrawal fee. You just pay the taxes on the growth. But like most retirement plans, there is a required minimum distribution, but there isn't in Roths. And so what it does is it gives you some of the flexibility to convert it to a Roth. Now, you have to keep in mind, there are some tax consequences, right? It is treated as income in the year that you are doing the conversion. And so if I heard you correctly, you're retired and maybe you're not taking Social Security yet. And if I got that wrong, apologies here, but I think that it could be beneficial, right? It's something that I also advise is having tax diversity, right? There are some reasons why you might want to have a taxable brokerage account for various assets, why you might want to have deferred growth, why you might want to have tax-free growth. And so having that diversity gives you optionality. And that's something you should always maintain. I honestly think that. But generally speaking, Roth conversions can be beneficial for the reasons that I listed. You just have to be careful because you don't want to push yourself into a higher tax bracket. So if this is a year where you're retired, you're not drawing any income, could be a good time to do it. But as always, it might be a good idea to talk to a financial advisor. And if you're interested, maybe we can help you out over at KPP. Just head over to InvestTalk.com. I'm going to start this talking point because it's an important one. But as always, you have to try and be predictive a little bit in terms of where you think the world is going, but you also have to be reactive. And investors are reacting pretty strongly to the prospect of significant policy changes following the re-election of President Donald Trump. What's the evidence for that? Well, stocks were up pretty massively today. The dollar strengthened and treasury yields have jumped. What does that mean? Well, there's some optimism for tax cuts. There's some optimism for corporate tax cuts, which could support further buybacks, elevate stock prices, like we just mentioned. There's some optimism for deregulation, which could increase corporate profits. There is some fears, though, associated with this as well. Tariffs, restricted immigration. And so you have to take everything within the context of what are the possible policy moves? What are the possible consequences? And we as investors have to digest all of this objectively. So when we come back from the break, our final break, we will dive into all of this, talk about how some of these things may be beneficial, but understand that there are costs to anything you do in terms of economic policy. So before the break, we were talking about how all policies have benefits and potential costs. So let's dive in here. So the first is tax cuts. Trump's plan is to rather extend individual tax cuts from 2017, but also reduce the corporate tax rate, potentially down to as much as, or rather as little as 15%. And so, while this is likely to boost corporate profits, right, in the short term, boost corporate profits, buyback windows open, companies buy back shares, keeps prices higher as there's fewer shares outstanding, buyers in the market. It's good for short-term growth. One issue, though, is it could push deficits to some pretty high levels, right? Both candidates proposed a lot of deficit spending. And so if there aren't associated cuts as well on the spending side, what does that mean? Well, there's a bigger budget gap. And that budget gap is projected to grow up to 12% of GDP by 2035. And so what we're seeing today, right? You see the 10-year yield rising, elevated borrowing costs. Well, that means maybe a weaker dollar, maybe gold is a good investment. Next up, tariffs. So the trade policy includes some pretty steep tariffs on imports, particularly from China, which could raise consumer prices, right? That's inflationary, could hurt growth, could also bolster some US manufacturing. And so maybe there are tariffs on semiconductor names, right? Maybe there are tariffs on industrial names. Maybe that should help you tilt your portfolio towards industrial names. Another downside, well, there could be some retaliation from trading partners, China, Europe. If we tax, right, if we have tariffs on one country, well, they're not just going to sit and take it. They might put tariffs on us as well. So that's something to consider as well. Immigration. Trump's policies to crack down on immigration could shrink the labor force, some estimate it could reduce GDP by up to 7% by 2028 if mass deportations proceed. I mean, listen, people promise things in an election. What is most important is to try and figure out what is actually going to happen and how that might affect growth. Lastly, I think that the most important thing is to bring together these policies in context, right? What is going to happen in the short term? What may happen in the medium term? What may happen in the long term? And how that affects the market as a whole. Our job as investors is to be as objective as possible, whether you agree with policy, whether you disagree with policy. But interpreting how those changes are going to affect you is what makes you a better investor and what helps you achieve your financial goals. Now, one more thing that is kind of associated with this is really just going back to the first Trump administration, right? There were taxes on China, a lot of the tariffs on China. A lot of those tariffs carried into the Biden administration, but it's different now, right? China's economy faces multiple vulnerabilities that could amplify the impact of these tariffs. One is property market crisis. Unlike in 2018, China's property sector is now in decline. It contributes to lower level of government revenues. There's an oversupply in real estate. The property sector may no longer be a strong driver of growth. Another one is higher debt levels. The downturn in real estate has led to unsustainable debt for local governments. Total government sector debt is projected at 147 trillion yuan. Now there's weak domestic demand, low wages, youth unemployment, and limited social safety nets really has restricted household spending, which remains below 40% of GDP. And so structural reforms are kind of needed in order to increase household income. Another, deflationary pressures, a lot of that caused from the property crisis. So tariffs could further reduce external demand, which would worsen industrial overcapacity and carry deflationary risks. I think overall authorities have been kind of cautious about one other aspect of this, which is yuan depreciation. The yuan would need to fall significantly to offset any tariffs that were imposed on China. And so overall, these economic pressures kind of complicate China's ability to respond effectively to increased tariffs, which may in turn be a driving factor in what is decreasing trade tensions, because the threat of tariffs on China and what it could do to the Chinese economy is vastly different than what happened last time. I'm Luke Herrera, and this completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family members about our free podcast downloads. Get yours anytime at iTunes, Google Play, and Spotify. Please be sure to review and rate us on iTunes. Remember, we can help you better understand your portfolio dynamics and calculate your investor risk number. Just go to investtalk.com and click the portfolio review button. This is a free and confidential service. If you're interested, head on over there and check us out. Independent thinking, shared success. This is InvestTalk. Good night.